In today's video, we cover an important topic named liquidity concepts, the different types of liquidity zones, and how retail traders can use this information to their advantage. So what is liquidity? Let's learn from the following example. It starts by smart money showing interest in buying an asset. For their orders to be executed, they need market participants to sell the exact amount smart money wants to buy. And since institutions trade the biggest volumes, they can't easily fill their positions. To do so, they look to hunt retail traders, stop losses using them as liquidity to fill their entire positions. It is speculated that smart money often manipulates price against the retail trader, deceiving and punishing traders against their positions. The first type of liquidity is the equal highs or equal lows. For the equal highs, price follows an uptrend, and then shortly after it loses momentum, forming this consolidation. The retail trader thinks it's time to sell short. Where does he usually place the stop loss? Above the recent equal highs, and this is the liquidity institutions will hunt. Very similar is what it happens to liquidity formed by equal lows. Price follows a downtrend with losing momentum. Here the psychology of the retail trader is that price bounced, and he positions himself for a break to the upside. His stop loss is usually right below the last low. He is prone to institutions stop hunting him. This is a live chart example for the equal highs liquidity. We see our equal highs being formed. So this is the liquidity where price moves towards. The liquidity has been taken, so we look to trade against the retail trader by sell shorting with stop loss above the liquidity and take profit below the last swing low. And this is a live chart example for the equal low liquidity. We are in a downtrend with losing momentum. Price forms the following equal lows as liquidity for banks to enter their positions by stop hunting the retail trader. Here's the wick that takes out the liquidity. Now that the retail trader has been stopped out, we want to follow institutions by buying long. We set the stop loss below the liquidity and take profit on the last swing high. The next liquidity type is the trendline liquidity. We often see retail traders use a trend line. The problem is the trend line acts point of interest for liquidity. In other words, it acts like a magnet, attracting price. The past one was for the ascending trend line liquidity, and the current one is for the descendant trend line liquidity. Usually what it happens is price swing trends. Then it breaks structure, creating an imbalance between buyers and sellers. This imbalance is important because if institutions want to push the price, they cannot just enter one big position. Instead, they open two more batches of orders to later be filled. As we know, their moves can be recognized on the chart. The inefficiency that needs to be filled is this zone named a bullish order block, an order block, which is the last low before price-breaking structure on swing points. It retraces downward and starts creating a trend line. The retail trader buys the support and sells the resistance. In this case, the trend line liquidity. Usually, the retail trader buys here on the bounce of the price, just to get a surprise later and get stopped out. We want to follow smart money, and our entry price should be order block, as an extra confirmation to know if the order block will hold. You should wait for the bounce on the zone. And after the retrace, if it breaks structure, we can enter with buys, looking to take profit, the last swing highs. This is the liquidity type for the bearish trend. Price breaks structure, creating a lower low that confirms the validity of this following order block. Then price creates a trend line. Instead of trading the breakouts, we wait price to eventually hit our order block where we can sell short as a confirmation of the continuation of the downtrend. And this is a live chart example, trend line being formed. Price breaks trend line. As long as it gets back in, we have a strong confirmation that this move was a stop hunt. So we follow the initial swing trend, which is bearish. Since we do not have an order block formed, we target the last swing low. Another liquidity type is the wick liquidity. The wick liquidity is often seen by a candle that causes a massive move in price, but then quickly reverses. For later price will take that wick. The reason is there is the retail's trader stop loss, just to take the trade in his favor after stopping him. There is the wick. We know there is a lot of liquidity sitting below it. We wait smart money to take out the liquidity. And now we can buy here. And we look to take profit on this structural high. The order block is also a form of liquidity. The order block is defined as the last green candle before a dump, or the last red candle before a pump. We mark the zone, and wait price to retest and fill the liquidity, moment where we can enter our position. Price following an uptrend, then breaks structure. The last green candle before the dump is the order block, which is this one. We mark the zone and wait for price to retest. Price has filled the order block. We can even go on lower time frames to catch this short. We place stop loss above the order block and take profit below last swing, low for a 5.8 risk to reward ratio trade. And that's it for today. Thank you for watching.